Would you change the way you look at money if the world's biggest investment giant made a multi-billion-dollar bet on a technology that most people still don't fully understand? Today, that's exactly what's happening. And unless you're paying close attention, you might miss one of the most significant shifts in global finance since the invention of the internet. Imagine waking up to headlines that BlackRock, the $10 trillion powerhouse that helps decide where the world's wealth flows, just bought millions more in Ethereum. Not Bitcoin, not stocks, Ethereum. Suddenly, ordinary investors, hedge funds, and even governments are asking, what does Wall Street know that the rest of us don't? Is this the dawn of a new financial era or just the latest hype train destined to crash? As the dust settles on BlackRock's astonishing $8.65 million Ethereum purchase, on top of its already massive $3.5 billion ETH holdings, a bigger picture comes into focus. Ethereum isn't just another cryptocurrency. It's rapidly becoming the backbone of everything from decentralized finance to NFT art, supply chains, and even the tokenization of real-world assets like real estate and bonds. But why now? Why is BlackRock, the emblem of conservative, slow-moving institutional power, racing to expand its Ethereum stake at this very moment? To answer that, we have to step back and unravel the complex web of finance, technology, and ambition that's colliding on the blockchain. Let's rewind. If you had said just 5 years ago that giants like BlackRock would be pouring billions into a digital currency built by a group of coders, you would have been laughed out of the room. Back then, Ethereum was little more than a promising experiment, a smart contract platform with an uncertain future and more than its fair share of technical hiccups. Fast forward to 2025, the world has changed. Ethereum is no longer just the currency of crypto enthusiasts. It's processed trillions in value through decentralized finance, powers the majority of NFT marketplaces, and, crucially, is now handling 53% of all real-world asset tokenization, according to the latest research. We're talking about everything from tokenized stocks and real estate to new kinds of financial derivatives that simply didn't exist a decade ago. The toll booth at the frontier of digital finance, it's Ethereum. And BlackRock clearly sees what's happening. In just a few months, the asset management titan's ETH ETF, called ETH, has exploded with $13.7 million in a single day's inflow. As of May 2025, its total Ethereum stash has surged to $3.5 billion. For perspective, that's more than the GDP of some small countries. But this isn't just about numbers on a balance sheet. What's unfolding is the collision of two worlds, the buttoned-up, highly regulated halls of traditional finance and the wild, permissionless innovation of the blockchain era. BlackRock's moves are a signal to the rest of the financial world. Digital assets are no longer a fringe experiment. They're a force institutions can't afford to ignore. When the biggest fish in the pond decides to swim in these waters, the ecosystem around them changes, fast. Take a look at the backdrop. Ethereum recently completed its long-awaited shift from proof-of-work to proof-of-stake, a move designed to address two of crypto's biggest criticisms, speed and sustainability. Transactions are now faster, and energy consumption has plummeted. This upgrade, along with the upcoming Pectra upgrade, which has already pushed Ethereum's price up 17% in a single week, is raising hopes that Ethereum can finally overcome its historical bottlenecks, network congestion, high fees, and scalability limits. For retail investors, this is exhilarating and terrifying. For institutions like BlackRock, though, it's an opportunity to get in early on the infrastructure of tomorrow's finance. Ethereum's transition to proof-of-stake is a game-changer for institutional adoption, says a recent JP Morgan analyst report. It opens up a new era for staking and yield generation in regulated investment products. Why does this matter? Because it's not just about buying and holding ETH. It's about creating a whole new ecosystem where institutions can earn yields, launch yield products, and, perhaps most importantly, tokenize billions in real-world assets on the blockchain. Right now, around $1.2 billion in ETH is trading in just the top two pairs, ETH BTC and ETH USDT, on Binance alone. Trading volumes are up 15% as new money pours in, chasing growth and new opportunities. Active Ethereum addresses have jumped 8% just in the last month. That's not retail traders on Reddit. That's a sign of surging demand from bigger players, DAOs, and platforms building for the next generation of finance. Not convinced? Consider the boom in Ethereum-based ETFs. After the success of Bitcoin ETFs, regulators finally opened the door for Ethereum-based funds, allowing pension funds, endowments, and family offices to get exposure without the headaches of private key storage. Farside investors reported a massive $13.7 million net inflow into Ethereum ETFs on a single day, mostly driven by BlackRock's ETHA. But what's truly interesting is what's happening behind the scenes. Ethereum has become the digital real estate where real-world assets, known as RWAs, are being brought onto the blockchain in droves. These aren't just abstract tokens. They're tokenized forms of everything from real estate and private equity to short-term U.S. treasuries. This is seismic. JP Morgan analysts estimate that the market for tokenized RWAs could reach hundreds of billions within the next 5 years. And it's Ethereum, not Bitcoin, not Solana, that handles over half of these assets today. BlackRock is leading the way on this front too. Its BUIDL fund isn't just sitting on ETH, it's powering BounceBit's new RWA yield strategy, a platform designed to help institutions and high-net-worth individuals tap into lucrative yields from tokenized real-world assets. Let's pause to appreciate how quickly this landscape is evolving. From its roots as a decentralized application platform plagued by scaling headaches, Ethereum has become the foundation for new kinds of financial products, legal contracts, and even art. Just a few years ago, many in finance dismissed crypto as a passing fad. Now it's the crossroads where Wall Street and Silicon Valley are shaking hands, building the rails for a digital-first programmable economy. This is triggering a feedback loop. As BlackRock accumulates more ETH and launches new Ethereum-based products, other large institutions are drawn to follow. Each new wave of capital boosts liquidity, service offerings, and ultimately, Ethereum's price and influence. But there's another side to this coin, and it's not all sunshine and rainbows. As the institutions pile in, crypto purists worry about centralization and Wall Street taking over the very decentralized networks that promised to disrupt them in the first place. Some critics are sounding alarms. Ethereum risks becoming just another tool of Wall Street, warns independent analyst Ali Martinez. If enough of the supply is concentrated in the hands of a few powerful players, it could undermine the principles of decentralization that made Ethereum appealing in the first place. It's a valid concern. Ethereum's ethos has always been about open, permissionless innovation, a platform where anyone can deploy a smart contract or build a dApp. But as big money moves in, there's the risk of recreating the same power structures that blockchain was supposed to challenge. Yet the allure of institutional capital is undeniable. BlackRock's billions are driving investment, accelerating development, and giving Ethereum the credibility needed to win regulatory approval. As Bloomberg emphasizes, even the resilience of traditional stock indices like the Nasdaq is now intertwined with the momentum of digital assets like ETH. This interconnectedness is accelerating. Investors are no longer choosing between equities and crypto. Many are blending both, hedging against monetary policy shifts and seeking new, uncorrelated sources of yield. Adding to the complexity, the Federal Reserve's recent hawkish signals have dampened Bitcoin inflows, according to CoinShares, pushing more cautious investors toward Ethereum's upside potential. Suddenly, ETH is seen as a safer bet for sophisticated capital, especially as more conservative money looks for alternatives amidst global uncertainty. Still, the new reality brings challenges. As institutional wallets grow, so do fears of market manipulation. If a few players hold too much ETH, they could theoretically influence prices, voting on protocol changes, or even staking outcomes. There's also the specter of regulation. Will governments embrace Ethereum as a tool for financial innovation, or crack down with strict new rules to keep things in check? The answer remains uncertain, and it could determine whether Ethereum remains the engine of the digital economy or faces the same fate as other promising technologies stifled by red tape. The upcoming Pectra upgrade is a crucial test. If successful, it could enable Ethereum to scale to billions of users and cement its role at the heart of global finance. If it falters, the narrative could shift overnight, and BlackRock's bet might suddenly look a lot riskier. So, as BlackRock doubles down and the world's attention turns to Ethereum, we're left with a series of difficult questions. Will the open-source dream survive Wall Street's embrace? Can Ethereum balance its innovative spirit with the realities of big money and regulations? Or are we witnessing the start of a new monopoly, one that looks eerily familiar under the digital hood? The stakes have never been higher. And as BlackRock's billions move, so too does the very future of money. But where is all of this heading? And what needs to happen for Ethereum to truly become the foundation of a new global financial system? The answer might surprise you. So, we stand at a turning point. With BlackRock's expanded stake in Ethereum and the larger rush of Wall Street capital into the ecosystem, we're witnessing nothing less than a collision between the disruptive ethos of crypto and the relentless logic of global finance. But what happens next? What could the future hold as these two worlds fuse, clash, and reshape not only Ethereum, but the very way our financial system operates? Picture this. Ethereum's network, once dominated by developers and crypto pioneers, now courses with billions of institutional dollars. BlackRock alone holds over $3.5 billion in ETH, and its Ethereum ETF, ETHA, just saw a $13.7 million inflow in a single day. Trading volumes spike. Price surges 17% in a week. It's not science fiction. This is happening right now. But this influx is only the beginning. Imagine a scenario 5 years from now, where not just BlackRock, but the entire old guard of finance, Fidelity, Vanguard, JP Morgan, Goldman Sachs, all wield significant control over Ethereum's governance and staking pools. They have the resources to dominate validator nodes, direct developer funding, and indirectly shape protocol upgrades. Ethereum, the backbone of DeFi and NFTs, now processes a majority of real-world assets on-chain. Remember, it already handles more than 53% of tokenized real-world assets as of this year. What would this mean? First, the upside: unrivaled global adoption. Your mortgage, your bonds, your stocks, all living as smart contracts on Ethereum, transferring ownership in seconds, settled without banks, and accessible 24/7. Major banks and governments use Ethereum rails behind the scenes. The world's supply chains, insurance contracts, and even entertainment royalties run automatically, trustlessly, and globally. Ethereum will become the backbone of the world's financial plumbing, predicts Adam Cochran, partner at Sinamhine Ventures. But only if it avoids being captured by the very powers it was designed to disrupt. Institutional adoption isn't just about money. It's about legitimacy. Ethereum's inclusion in portfolios like BlackRock's signals to regulators and corporations everywhere: crypto is no longer fringe, it's essential. As Bloomberg reports, capital is already rotating out of traditional indices into crypto assets, with Ethereum leading the charge. If ETF inflows keep rising, we could see an entirely new asset class accepted by pension funds, endowments, and nation-states. But with this legitimacy come tremendous risks. As institutions accumulate ever larger ETH positions, the specter of centralization looms. With enough holdings, these players could exert outsized influence over on-chain governance, potentially vetoing upgrades, prioritizing features that serve their interests, or even nullifying transactions they dislike. The fear? Ethereum could morph from a decentralized commons into an oligopoly run for and by a handful of financial behemoths. This isn't just a theoretical risk. We've seen staking pools and validator clusters grow rapidly. If left unchecked, it could become easier for large actors to collude, whether overtly or through shared incentives. Regulatory dynamics add fuel to the fire. Positive regulatory clarity, like the pending approval of Ether staking within ETFs, could unlock another tidal wave of institutional capital. JP Morgan's analysts argue that ETH staking could be a huge step change for Ether ETFs, pending regulatory clarity. But the reverse is just as possible. Crackdowns, restrictive laws, or overbearing compliance could sap Ethereum's vitality or force major changes to meet the standards of Wall Street and Washington alike. And then there are the technical risks. The anticipated Pectra upgrade is set to boost throughput and network performance. But what if it falters? A major bug, exploit, or failed upgrade could shake confidence, especially if the stakes are measured not just in millions, but in the trillions of assets tokenized on-chain. As Ethereum's social and economic significance grows, so too does the size of the target on its back. Hackers, state actors, or rogue insiders could all see greater incentive to attack the network. But don't let the risks blind you. The opportunity here is enormous. Ethereum, by design, remains upgradable, battle-tested, and, at its core, open. Recent technical progress, like the transition to proof-of-stake, has already slashed Ethereum's energy use by more than 99%. Scalability upgrades are coming fast and furious. Community developers and even some institutional partners are actively investing to decentralize validators and expand access to staking. Technologies like Layer 2 rollups and distributed restaking protocols are democratizing participation and making it harder for anyone, even BlackRock, to control the network. So what lessons can we take from this high-stakes chess match? And more critically, how can you, as an individual investor or even just a curious observer, navigate this rapidly shifting landscape? First, realize that the game has changed. Ethereum is no longer the experimental playground of the crypto faithful. When a juggernaut like BlackRock makes repeated multi-million-dollar bets in open view, it's a signal. Institutional capital will bring both stability and turbulence. Prices might rise, but so will scrutiny and complexity. If you're holding ETH, educate yourself about liquid staking, validator decentralization, and the protocols that keep Ethereum resilient. Consider diversifying your exposure, not just in tokens, but also in projects and platforms pushing decentralization forward. Watch for concentration in staking pools. If too much ETH clusters in a handful of validator addresses, network health could be at risk. Stay informed. Regulatory winds shift quickly. Subscribe to reputable news sources, track ETF inflows and outflows, and listen to both crypto-native and Wall Street voices. When analysts like Ali Martinez or institutions like CoinShares flag opportunities or risks, pay attention, but also verify. As we've learned, narratives can shift overnight. But don't just watch the headlines. Look deeper. The real innovations may not always be in the price or the ETF charts, but in the technical upgrades and governance proposals simmering beneath the surface. The Pectra upgrade, for example, could make Ethereum fast enough to rival Visa and MasterCard, but it's also a test of how well the community can coordinate and execute at scale. Involvement isn't just about holding coins, it's about participating in on-chain governance, providing feedback, and supporting open-source development. If you're in traditional finance or just beginning to explore crypto, understand that Ethereum isn't just a speculative asset. It's quickly becoming a foundational layer for everything from decentralized identity to global supply chains. With tokenization, even assets previously walled off from ordinary investors, commercial real estate, fine art, private credit, are being broken into pieces and made accessible. As BlackRock's BUIDL fund powers new RWA yield platforms like BounceBit, opportunities for passive income, yield farming, and portfolio diversification are multiplying. But so are the risks. Do your own research, understand smart contract security, and be wary of projects that promise unsustainable returns. And one more practical takeaway: decentralization isn't a given, it's a process. If you care about keeping Ethereum open and permissionless, participate. Run a validator node if you can. Vote on proposals through DAOs. Support projects that prioritize openness and resist centralization, even as they welcome new investment. Ultimately, Ethereum's future, whether as a beacon of decentralization or a captive of consolidated interests, will depend on what the community tolerates, encourages, or resists. So, can Ethereum balance innovation and decentralization with the demands and dangers of massive institutional adoption? The answer is, it's a work in progress, and it depends on us, all of us. Right now, the momentum appears to favor Ethereum's resilience. The network is more active than ever. Developer activity is at all-time highs, trading volumes are surging, and the ecosystem is experimenting with governance models designed to resist capture. But the pressure is real and growing. The secret fact most people don't realize? While everyone is watching BlackRock's ETF inflows and market moves, there's a quiet arms race happening on the technical side. Several of the largest staking pools, some run by community collectives, others by upstart DAOs, are developing open frameworks for decentralized validator onboarding. This could make it far more difficult for any one institution, even a trillion-dollar giant, to quietly corner the market. The next big fight for Ethereum's soul may not be played out in ETF flows or price charts, but in these governance and technical trenches. In the end, Ethereum's path will be decided by its unique blend of code, capital, and community. The network has always evolved by absorbing new pressures, whether technical, regulatory, or financial, and finding ways to adapt without losing its core values. For you, the implications couldn't be bigger. Whether you're an investor, a builder, or just someone curious about the future of money, now is the time to pay attention, get involved, and help shape what comes next. Keep your eyes not just on price, but on the fundamentals: decentralization, security, and innovation. And remember, while Wall Street may bring scale, Ethereum's destiny is still, for now, in the hands of those who show up and build. What do you think? Is Ethereum on track to become the backbone of global finance, or is it at risk of being captured by the very forces it set out to disrupt? Let us know in the comments below. Are you bullish on ETH's future, worried about centralization, or somewhere in between? If you found this deep dive valuable, don't forget to like, subscribe, and ring the bell so you never miss our latest insights. For those ready to take it to the next level, check out our exclusive Discord community and newsletter, where we unpack breaking news and research, often before it hits the headlines. Thanks for watching. The future is unwritten, and it's being built right now on Ethereum.